These are the 9 financial goals you need to achieve before you're 30, otherwise you might as well give up. Okay. Okay, wait. Look, it's fine if you're already in your 30s, just make sure that you work on these as soon as possible. Listen, studies show that Gen X, people in their 40s and 50s, are financially ruined because they made really poor financial decisions when they were younger. Yes, even worse than buying avocado toast. And when it comes to retirement, both millennials and Gen Xers have saved around $35,000 on average. But the problem is, Gen Xers are much closer to retirement than millennials. So if you want to be well on your path to financial freedom, you gotta start with these 9 financial goals. Especially the 4th one. I don't say this often, but this is the one goal you need to tackle before you do anything else, because knowing is half the battle. Knowledge. And this is a mistake that most finance influencers don't address, and it's simply stopping and asking, what do you want? Do you actually want a mansion on the beach, a Lamborghini, designer clothes? Do you want that because you actually want it, or is it what society says you should want? Do you want to be your own boss, have the opportunity to amass unimaginable wealth, but at the same time be extremely stressed and have very little free time? Or do you want to have a more chill lifestyle, where you're financially secure, but you still have free time to spend with your friends and family? There's no wrong answer, but whichever path you choose, make sure it's what you truly want deep down. Here are 2 tools that helped me figure this out. First is journaling. Start recording every profound thought you have, and take note when you're most happy. What were you doing? And here's the most important part. How long did that happiness last? Reflect back on that moment and see if it still makes you smile today, or was it just a really fleeting emotion? Second, take the Myers-Briggs personality test. It's a simple series of questions that will let you know what type of person you are. I'm personally INTJ, which means that I'm a bit more introverted and I tend to think things through logically rather than intuitively. Now, this test isn't going to define your financial goals exactly, but it will help you learn more about yourself and the direction that you should head towards for a fulfilling career and ultimately financial success. And if you already know your personality type, comment below. Okay, enough philosophical mindset stuff. Let's actually get into the nitty-gritty. I'm sure you've seen this guy before, Dave Ramsey, notorious for his hatred of all things debt, which makes sense because if you don't actually know debt, like actually know debt on a best friend level, then it could be bad news. But here's the truth. The idea that you need to avoid all debt is not practical and not good financial advice. Wow. Despite what my boy Dave preaches, not all debt is bad. There's actually a distinction between good and bad debt that I'll explain. And understanding this nuance is the difference between financial freedom and not. Okay, bad debt, what you're probably most familiar with, can be stuff like car loans.
A record 7 million Americans are at least 90 days behind on car loan payments.
Car buyers in debt to the tune of $1 trillion.
It's stuff where you make payments for months or years that ultimately do not increase in value. For example, if you buy a new car, the moment you drive it out of the dealership, it's gonna lose value. In the first year, the average car loses about 20 to 30% of its value, then depreciates 15% every year afterwards. Other bad debt includes high interest credit card debt, payday loans, etc. Essentially, bad debt is stuff that doesn't help you make progress towards your financial goals. On the other hand, good debt is an investment that may boost your income or net worth in the future. Stuff like using leverage to purchase real estate. Here's a really simplified example. Imagine that you have $100,000 in cash and you could buy one of 2 properties. One property costs $100,000 and the other costs $500,000. Now, is it better to buy the $100K home without any debt, or use your $100K in cash as a down payment for the $500K home and pay the rest off with a loan? And here's the kicker. The average appreciation rate for both of these properties is 5%, meaning it goes up in value by 5% every year. If you bought the $100K property, the next year your net worth would go up by $5,000. Now, if you took out a loan and bought the $500K property, your net worth the next year increases by $25,000. That's a huge difference of $20,000. So, in essence, you can imagine good debt as something that can improve your long-term financial situation. But if you're already stuck with a bunch of bad debt, here's my favorite strategy to get rid of it. And it's called the avalanche method. Here's how it works. Think of how much money you can budget to pay off your debt every month. Make a list of all your balances and the minimum payments required. Now, list them in order of lowest to highest by interest rate. For example, let's say you currently have a $1,000 credit card balance with a 20% interest rate, a $2,800 credit card balance with a 10% interest rate, and a $17,000 car loan with an 8% interest rate. What you want to do is make all minimum payments on your balances and put any leftover money towards the balance with the highest interest rate. In this example, it's the credit card with the $1,000 balance. After you paid off that balance, move on to the next balance with the highest interest rate. And that's the $2,800 credit card balance. And again, putting as much money as you can towards it, and then just rinse and repeat. This method is, mathematically speaking, the most efficient way to get rid of your debt. Next, you need to understand the true power of your credit score and be able to harness it, like Thor's hammer. Because it could be the difference between wealth and poverty. Think of your credit score as a quick metric used by lenders to determine how likely you are to pay them back. And the less risky they view you, the more money that you can end up saving. Let's say you want to take a $30,000 car loan and you want to pay it off in 5 years. Well, if you have an excellent credit score, you could get an interest rate of 3.5%, meaning that in 5 years, you would only pay $2,700 in interest for that loan. In comparison, if you had just an average credit score, you get an interest rate of 8%, so you end up paying around $6,500 on interest alone. That's a difference of $3,800 over time, and I don't know about you, but that's quite a bit of money, which you could have saved and used for the next financial goal, which is probably the most important when it comes to achieving financial freedom. Now, the easiest way for you to build credit by far is by using a credit card. And pay attention here because this is vital. You need to be responsible and pay off your credit card bill on time every month. Because even if you miss just a couple of payments, that can ruin your score. My suggestion is to only use your credit card if you actually have the money to pay it off, and only start with smaller items like your gas or McDonald's cheeseburgers.
Excuse me. Yeah? Would you watch my place in line? I'm just gonna run over to McDonald's. Yeah.
I still remember after I graduated college, I started working and I met this guy at a party, and he was super cautious his entire life. His parents told him that credit cards were evil, and so he only used his debit card ever. And because of this, he had no credit score. He had no credit history, which made him look super high risk to lenders.
Give me rent. You'll get your rent when you fix this damn door!
And he had so much trouble trying to find a place to live because one, landlords don't like renting to you if you don't have a credit score to show that you can pay your rent on time. And two, even just setting up his electricity and cable bills, he had to put a couple extra $100 as a down deposit that he wouldn't be able to get back until a year after his service ended. The next most important goal is, at a minimum, to learn about the stock market. When people hear the word stocks, they think about fancy degrees, fancy suits, ties, watches, drinking scotch, and looking at charts all day. But this isn't true. No one wears suits anymore. Hollywood makes the stock market seem more complex than it actually is, and it's actually easier now to get started than ever before. And the earlier you start, the better off you're gonna be. And here's how you can retire a millionaire when you're 50 with just the stock market. Let's say you're 20, right? And if you contribute $500 a month into an S&P 500 index fund with an average rate of return of 10%, then in 30 years, your investment would be worth over $1 million. By the way, index funds, they are super safe. Essentially, instead of investing in one stock that could go up or down with the volatility of the market, with an index fund, you automatically are invested in hundreds of different stocks that will significantly reduce your risk. And you can pretty much just set up and forget it. To get started, you can use any app you want. But here's a free present just for my viewers. That's you guys. Moomoo is actually giving you free stocks to help you get started. For a limited time, you can get a chance to win 2 free stocks valued up to $3,500 each from just opening an account and depositing $1 with my link down below. So in total, you can earn 2 free stocks worth up to $7,000 by just depositing $1. Now, Moomoo is a trading app, and if you open a brokerage account with it, you can trade commission-free if you're a US resident and are trading in US markets. It was also mentioned in the best online trading brokers and platforms by Benzenga. The Moomoo app has super cool professional grade tools without being too scary or intimidating. Whether you're a new or experienced investor, Moomoo offers customizable features for you, from the ability to simply invest to easily look at a company's financial data, analyst ratings, all the way to advanced charts and detailed stock analytical tools. So make sure you pause the video and get a chance to win 2 free stocks valued up to $7,000 with the link down below. It's basically free money, so you might as well give it a try. Another thing that most finance influencers never talk about is that you need to start investing in yourself. Who, me? To be fair, this could mean 1,000 different things, but the most obvious is in your education. And no, I'm not talking about college. I'm talking about learning new things right now, like literally right now, because learning never really stops. And it's possibly the best return on investment you can ever make. Just imagine a single book that can cost maybe $10. That $10 investment could return over 1,000 times in value. That book can teach you how to maximize your productivity to achieve more, or how to negotiate better deals. Yeah. $7 trillion. Oh,
I can just smell the money already.
Think of that book as a way to download 50 years of knowledge and experience from the author for just $10. And if you don't like reading like me, it doesn't even have to be a book. It could be free videos on YouTube like this one, where you spend a few minutes learning something new every single day. So make sure you turn that like button into a beautiful black so you can see more of my videos on your homepage. Or look for a mentor, check out some courses, and even check out educational newsletters like the one that I write 100% free every day called the Daily Market Briefs. It helps you understand the stock market news easy and quick in just 1 minute every morning for free. Link is in the description. There's so much information out there, and all it takes is for you to have the drive and initiative to get started, hopefully before you're 30. But it's not just self-education, it's also your health. Invest in a more healthy and active lifestyle that can save and make you thousands later on in life. Did you know that on average, people who are considered obese at age 50 pay about $36,000 more in health costs throughout their entire life? Not only that, but people who are considered healthy earn about 28% more than those who aren't. Now, there's one piece of financial advice that you need to completely ignore because it's trash, and it's this. Conventional advice says you need to save a year's worth of salary before you hit your 30s, but they don't consider that your 20s are extremely volatile. A new grad could be earning $30,000, and then all of a sudden they get a huge promotion at 29 where they make $100,000. Are they expected to have 100K saved up all of a sudden? Or what if you suddenly lost your job? How do you factor that into your savings amount? Here's what you should aim for instead. Save the average of your annual salary throughout your 20s by your 30s. For example, let's say you make 30K a year from 20 to 25, and then 70K a year from 26 up to 30. So in total, you make around $460,000 throughout those years. Divide it by 10 and you should have about $46,000 saved up. Now, if you could save more, that's fantastic too. But listen, it's not always easy to do this, depending on your situation and also where you live. This isn't a one-size-fits-all solution. Understand your own personal financial situation and readjust the goal accordingly. If it's completely unreasonable to save that amount of money and it just makes you really stressed and anxious, then save a little less. On the flip side, if this amount seems too easy, then raise the bar. Personal finance is personal for a reason. But here's actually what you can do to make more money and ultimately save more money. And it's creating additional streams of income before you're 30. Did you know that 65% of self-made millionaires have at least 3 different income streams, 40% have at least 4, and 39% have 5 or more? And relying on a single stream of income is riskier than you think, because the moment a tragedy happens, like Thanos snaps his finger and your boss disappears, it could all be over. There are 261 working days in the year, and if you could just make an extra $20 each of those days, you would have an extra $5,000 in your pocket by the end of the year. But the question is, how do you do that? Now, you could do the traditional thing that I've done before, do a bit of overtime, ask for a raise, get some extra qualifications, or go get a better job. Or you can do what the cool kids are doing nowadays and start a side hustle.
Thank you very much, sir.
Yes, sir.
You got a bill of sale here.
Starting little side hustles is actually what jump-started my journey into entrepreneurship. And all it requires is putting maybe an extra hour a day into it. I still remember the very first side hustle I had in middle school. My parents had a bunch of these $2 bills just laying around at home. And one day I brought some of them into school and I found out that none of my friends had ever seen a $2 bill before and they thought it was super rare. And so I did what any normal person would do and I flipped them. I started selling these $2 bills for $5 to these kids and I made a pretty nice return. Over time, I kept this hustle mentality and then I started selling ebooks, clothing designs, phones, etc. But honestly, it doesn't matter what you do. What matters is that you just start. And for some ideas, check out my favorite best side hustles to start in 2022. After you finish this video, link is in the description down below. Now, this could be the one single determining factor that determines if you ever achieve financial freedom or not. And it's simply, you need to start normalizing talking about money with your friends, family, and coworkers. And listen, I get it. Talking about money is not easy at all. It's freaking awful. And there's a lot of negative stigma surrounding this topic. But this is the main reason that many of you, including me, grew up without a lot of knowledge about finance, investing, or debt. And it's time to break the cycle. Here's why. You want to make sure that the people that you surround yourself with have similar financial goals as yourself, or at least understand the position that you're coming from. Because if all your friends love to spend money on silly stuff like a magic lamp over there, but you're trying to save your money for your future, then you're probably going to spend more money than you're actually comfortable doing that in order to hang out with them. And that applies to your life partner too. You need to be on the same page or else you're going to have conflicting goals and, well, you're going to have a bad time. Or even with your coworkers. If you never talk about your salary, then you'll never know if you're getting compensated fairly for your work. What if you're getting paid $10,000 less just because you can't negotiate as well as Chad over there, even though you two do the exact same work and are equally qualified? Damn it, Chad.
Thank you, Baxter.
By starting the conversation, you can take the power back from the employer and break this negative money cycle. There are two things in life that are unavoidable: death and taxes. I remember when I got my very first paycheck and I just saw how much the tax man had taken from me. I was shocked. And this is one of the reasons I started looking into ways on how to reduce what I had to voluntarily contribute to Uncle Sam. And this is something you need to learn before your 30s, unless, you like giving your money away. The easiest way to get started is with a tax advantage account, something easy like a 401k. Check with your employer. It's essentially a retirement account that you can contribute money to lower your tax income, saving you a good chunk of money. Here's a really simplified example, and yes, I know I'm not taking marginal tax rate into account. Let's say you earn about $40,000 a year, and you get taxed 25% of your income, so you would pay $10,000 in taxes, and at the end of the day, your take-home pay is now $30,000. But what if you could take home even more than that? Let's say you started contributing just 5%, or $2,000 of your $40,000 income towards your 401k. That $2,000 was taken pre-tax from your income. And so to Uncle Sam, it looks like you only brought home $38,000. That means you would only pay $9,500 in taxes if we were to stay at the same 25% tax bracket. So not only do you save $500 in taxes a year, but you also have an additional $2,000 saved up in your retirement account for when it's time to party. There are a ton of other ways to save on taxes, like a Roth IRA, HSA account, tax loss harvesting, charities, etc. I'll make a more in-depth video in the future. But first, just get comfortable with the tax system, because it could save you millions of dollars down the line. If you strive to achieve these 9 financial goals before you hit your 30s, you'll be light years ahead of your friends, your family, and coworkers who decided to do other stuff. But this isn't the only secret to reaching financial freedom. I bet you didn't know that you were actually programmed to be poor from the day you were born. Check out this video to learn how you were brainwashed to think this way and how you can stop it.